Welcome everybody to Market Masterclass. My name is Bruce Curran and I've been in the financial services industry for some 30 years. I'm delighted to be here at First Metro Securities offices in the heart of Makati with our guests for today, Alexander Gilles, who's with First Metro Securities, and we're going to talk about how you as foreigners from any nationality can get into the stock market or into specialist funds run by First Metro Securities. So let me introduce Alexander Gilles and let him introduce himself, and we'll go through how we can invest here in the Philippines.
Well, thanks, Bruce. Yes, my name is Alexander Gilles. My friends call me Sandy, and I'm here in First Metro Securities to orient the new clients as to how to get started in stocks, how to buy your first ever share of stock, your first batch, your first portfolio, or if it's too much detail for you, how to invest in a mutual fund, which means an expert will take care of your money and invest it according to certain principles, such as whether you want to be aggressive or you want to be very conservative or you want to be somewhere in between. Now, shares of stock have grown in popularity because it's been proven that since 1987, they've gone up an average of 9% a year, all the way to the 2016. Now, if you start counting 10 years ago, the top 30 stocks in the Philippines have gone up 15% per year, per annum, every single year since 2006 all the way to 16. So therefore, you do have a steady upward climb, and I think it's fueled by the economy growing now around 6 to 7% a year. We're hoping that sustains all the way to 7, 8, 9% per year in the future. And so therefore, it becomes interesting for people to try out their first ever share of stock.
So may I ask, in terms of as economies go in Southeast Asia, I believe the Philippines is doing particularly well compared with other countries in Southeast Asia?
Yes, the Philippine economy is not very good with trade, not very good with exports, imports, but paradoxically, that's been de-emphasized in the last so many years, and then what's been important in the last so many years has been a strong domestic population that will be very strong in terms of consumer spending. So that's been the driver of the last 5 years, and I think thankfully for the next 5 years it'll be driven more by investments, meaning the government spending more on roads, bridges, airports, and then investors being invited in to come in and help set up the airports, the toll roads, and the hospitals, and the factories, and the call centers. So therefore, the two driving forces will be the consumer spending and then also the construction or investment-led growth. Yes, we've been very much behind in that respect, meaning spending only 2% of GDP on infrastructure. It should be somewhere around 5%, more like Asian standard. So as we make a very big catch-up move, this means growth. If you look around you, you don't see much infrastructure, and you might say, I don't like to invest in this country. But if you simply know the plans and the activities ongoing as to how to catch up with the deficit, then you would say there's a lot of growth and a lot of activity coming on. So obviously there's going to be lots of deficiencies, but they're going to be corrected over time, and that's what will drive the growth. So I think many people now have their money in bank accounts earning 1%. They've tried to put money in government bonds earning 3%. Interesting. Treasury bills give 2, government bonds give about 3 or 4. And then if you are able to get your hands on a corporate bond, you might get 5%. Certain shares of stock in the telecom and utilities industries give good cash dividends, sometimes 6%, sometimes 7% a year. So that becomes increasingly interesting to people who have never quite earned more than 1% a year before, and inflation is 2. So therefore, keep looking for strategies to earn 6% a year. And my first recommendation to the beginner is to buy some stocks that pay cash dividends. And if you come to my office, I will explain the names of the stocks that give you 5, 6, 7%.
But that's an annual payment?
It's an annual promise. It's not a guarantee, but it's an annual best efforts promise. And happily, the promise has been fulfilled year after year for so many years, 10 years at least. The reason is that the utilities and the telecom companies are doing very well. Even though they may have stumbled, the more internet they offer, the less phone calls people make. So they tend to lose revenue on the phone calls and the text messaging because people send messages via online messaging apps. So they had a drop in revenue because of that. And as they try to get into the internet space, they're not very good at it, and so they stumble and fall a couple of times. So there's been some drops in revenue for the big telecom companies. But long term, everyone needs a phone, everyone needs a nicer phone every year, and everyone wants to have unlimited calls, unlimited data, unlimited internet. So I think that's the progress is upwards.
Right. So you mentioned bonds. Is that sort of are they particularly people who want to be a little bit more defensive?
Yes, if you, for example, are in charge of a big amount of money and it's not your money, it's the foundation's money, or maybe there's a university or hospital endowment money, you're just the steward, then you need to take care of that money and make sure it's secure. So put it in government bonds, earning 3 or 4% a year, depending if it's a 10-year bond or a 20-year bond. The longer year bonds give you 4 point something. Then you would be very prudent in that regard. These bonds are, I would say, safer than a bank deposit because they have the backing of the national government.
May I ask, and in terms of, you say there's sort of like 5-year, 10-year, is there a lock-in period, or are you, as an investor, can you come out?
Well, there is the optimum way to deal with that bond is to hold it for the entire maturity. Since you're investing for 10 years, 20 years. But if you want to sell it before the time is up, then you might have to sell it at a discount, so it might not be to your advantage. If you're planning to ditch a 10-year bond 7 years ahead of schedule, then don't buy the bond directly, buy a bond fund. Meaning there's a mutual fund that buys the bonds one by one, and then you can get into the mutual fund and get out of it much easier than attempting to sell a 20-year bond at a discount.
Right. So if you want flexibility and
ease of yes, then it would be much better to get into a bond fund because you can get in immediately and you'll get the paperwork done in 3 days. And should you wish to exit, you can also exit in 3 days' time. But with a bond, you need to negotiate with a possible buyer, and in the first place, look for the buyer if you're selling so many million pesos worth of bonds. Just like in real life, it's easier if you're dealing in large quantities. Then you can either get a good price, sell at a high price, or if you're buying, then buy at a discount if you're dealing in bulk.
Right. But you say, as an individual investor, what are the sort of minimum amounts?
There are retail treasury bonds that go for 5,000 pesos. Now, there are other bonds where it's more economical to go for 50 million pesos per purchase. If you're a manager of a foundation with 300 million pesos, then it will be very easy to get into the right bonds and to hold it for long term. But if you want some flexibility, then better get into mutual funds that invest in bonds.
Right. And in a mutual fund, you can invest what amount?
Starting from 5,000 pesos minimum. And then additional minimum of 1,000 is really for the average man on the street who wants to save for his retirement or save for emergency money. And I also recommend for them to save ahead of time for possible endowment to their grandchildren, even though they may not yet have any children yet, but plan ahead 30 years ahead. Like I'll tell them, save 100,000 pesos now, and in about 10 years, if it's growing at 15%, it will be 404,000. If you let it grow for 20 years, it becomes 1.6 million, and in 30 years, it becomes 6.6 million. So therefore, if you are thinking ahead of time that in 30 years, I will have grandchildren, and I might want to bequeath this to them, or at least take care of their scholarships when they get to a really nice university abroad, and then the money would be available should my grandchildren ask me for help with scholarships. If not, then I can donate it to the typhoon victims or to some other worthy cause.
Okay, so bonds. What about the other end of the market? If you want to be a little bit more aggressive and progressive,
yes.
What's the choices there?
I would say look at the economy. The economy is growing, and the parts of the economy that are growing have to do with food, clothing, shelter, energy, transport, telecom, banking, mining and minerals, and various sectors. So therefore, you should be in food, clothing and shelter. You should be, meaning in food companies, in property companies, energy companies, telecom companies. So there should be some of these industrial and manufacturing companies in your portfolio for you to participate in the economy, for you to get the 7% that the Philippine economy is growing. Try to get into the top 3 telecom companies, food companies, property development, banks. Buy at least one each, one per sector, so that you're, so to speak, participating in the economy. You have a little economy right there in your portfolio.
And then if you're not quite sure which ones to choose yourself, you can do the same as the bond. You can get a fund.
A fund, yes, yes. If you're not quite sure what stocks to buy, then you would get into this, for example, the Save and Learn Equity Fund, which is run by experts, and then they buy and sell equity funds. And then you also have the Save and Learn Balance Fund, which is half stocks and half bonds. And then this one is nearly all bonds and cash and time deposits of the sort. No? And this would be a quick and easy way to get into stocks. But there is very little that should keep you from getting into equities yourself, because you can identify at least 5 stocks out there that you grew up with. For example, your house might be built by company A, maybe your car was built by company B, and your building is owned by company C. So these are companies that you deal with, so you're familiar with them. And maybe your salary is paid by a listed company, letter D. So therefore, it should be easy for you to buy shares of stock of all those companies that you deal with. Maybe you go to a grocery store run by company letter E, for example. Then you would go to buy shares of stock of that grocery store. And all you have to do is to open an account with the securities brokerage company, go to their website, click open an account, and follow the instructions. And then you'll be able to sort of do it yourself and build your own portfolio.
Right. So they can come and see you first, and chat about it, then they can go home and register on the internet.
Yes, they come and see me, and then I give classes in the office about how to get started in stocks. What are the risks and rewards? What are the benefits? What are the advantages and disadvantages? I tell them honestly, this is the way to make money. This is the way to lose money. If you're careless, you can lose money. If you're not prudent enough, you're not patient enough, you could lose money. So their eyes are open about the possibilities. If you play your cards well, then you could earn at least 8% a year, because the profits of these listed companies are moving up 8% a year. I say that modestly because I personally am hoping for 15% a year, which has been the performance for the last 15 years. Last 10 years. Since 2006 to the present, 15% a year on the top 30 stocks. Now that 15% is average for the top 30. Some of them are more than 15, some of them are less than 15. So if you can judiciously select those which can grow more than 15, then you should get at least 15. If you don't want to gamble by selecting only the most choice companies up there, since you can't figure that out anyway, then you say, I'll just buy the top 30.
Okay.
And
like
the index, right? So the top 30. And there's a way to do that now by buying a certain stock called the First Metro Exchange Traded Fund. It's a mutual fund which is listed on the stock exchange. So therefore, you buy it just like a stock. It made its debut at 100 pesos per share, and then it went up to 115, 120, down again to 109, up again to 115. Now it's 121. So it's up 20% in 2 years.
Okay. Sandy, that's very helpful. What about, you mentioned earlier inflation. And you mentioned that if you're in a bank deposit account, you're getting 1%, and inflation is 2%. Does that mean that you're really at the end of 1 year, you've sort of lost money?
Your 100 pesos is now virtually 99.
Right.
Yeah.
So inflation is quite a critical aspect. And inflation here is fairly under control?
Stable at between 1.7 and 2%, but it might creep up to 2.2. So you really don't want your money to be earning less than 2.2.
Right. So just your sort of daily money in the bank, but then get into stocks and
Yes. Well, there is a reason why money has to be in the bank. It's for household expenses. All right. So money for household expenses must remain in the bank. Now, money that you can that you need to save for 10 years, for example, for paying tuition or making house payments, that can go into bonds since you have 10 years to work with. Now, I explain to people that if you're a 30-year-old worker now, you will retire at the age of 60. You do have 30 years of investments to make. So save 30,000 pesos now per year, let it grow at 15% a year as best as you can, and then it'll creep up to the value of 800, 900,000, maybe a million pesos. So you do that every year, save 30,000 pesos, don't touch it until you're 60 years old, and you will have pocket money all the way till you're 60, 61, 62, 63. Now, sir, do I invest for 30 years? Yes. What if I don't live long enough? Well, at least your descendants will inherit the money, and they will bless your name for having had the wisdom to invest so that the money grows. Otherwise, if it were growing at 1% a year, it would be below inflation.
And that's normally part of the package when somebody does an investment. They have it like a trust or a letter of what happens in the event of something happening.
Yes. When somebody opens a brokerage account, then that money forms part of his estate. So if he passes away, then the heirs get to own that, and then the Bureau of Internal Revenue gets its share of the inheritance tax.
Well, this seems very encouraging that things over the next 5 years look as though they're going on a quite steep upward curve.
No. Steep upward curve is too optimistic.
Okay, right.
I would say gentle upward curve, something like if the economy is growing 8% a year, 7% a year, I would hope that the top listed stocks, their net profit should be growing between 10 and 15% per year. So that means if you choose the right stock, your money could grow between 10 and 15% a year if you choose the right stock, and if it's only that one stock. If you choose several, then you'll get an average of somewhere between 15 and 5, so maybe 10. So maybe you're back to the average of 8 or 10%. So buy a combination, by 10, by 20, by 30, and then you should kind of follow the average growth of, now conservatively stating it at 8% a year. Now, remember that just one thing I wanted to point out to the customers is that the Philippines is now in a very unique period of time where it's got lots of workers, 54 million workers, and then lots of kids, about 60 million kids. So we're a nation of 112 million people, and very few retired, lots of workers, and lots of kids. And those kids are going to be future workers. So this means that the economy potentially can grow for the next 30 years, constantly feeding workers into the production chain, and then also having a lot of mouths to feed, right? So I know that it means for a lot of hunger, but it means also that they work harder to make more money to put food on the table. So a little bit of desperation it's sad to see that the people are desperate to find work anywhere in the world, but it's also encouraging to see how hard they're willing to work to put food on the table. So I think that in the same way that the US economy expanded very fast from 1950s to the 1980s, and the Japanese economy expanded very fast from the 1960s to the 1990s and then tapered off, I think the Philippine upswing is starting 2015 and running all the way to 2045.
Well, Sandy, that's very, very interesting, and gives a very clear picture of the possibilities, potential, and probably a very good time to consider stocks and mutual funds here in the Philippines.
Yes.
I'd like to thank you very much for your time and input.
Yes.
And recommend anybody who wants to look at getting into investing in the Philippines to talk to First Metro Securities, and they'll be delighted to inform you, fill you in, and get you started in the potentially healthy growth economy.
May I offer one final word of advice? Many beginners, if they're facing a stock market that's moving up in a very volatile upward curve, they wait until the stock market is up, then they buy. The normal thing that happens after that is the stock market goes down, and then the poor beginner sells. And then he waits until it's up again, and then he buys. The next point in the cycle is, however, a down cycle, and then he gets scared and he sells. So he buys, he sells, he buys, he sells. And that is the absolute wrong way to do it for beginners. And that's why I give classes on how not to approach this the wrong way. So you must be either buy very patiently, month after month or year after year, or you buy and wait. Just buy today and then wait for many years to pass. And then your investment simply can grow 10 to 15% a year if it's the right stock. If it faces good economic fundamentals, huge demand for food, for electricity, for property, for banking services, for minerals too.
Well, thank you very much for that final bit of very important advice. And thank you very much for joining us today. And that's Market Masterclass for today. And thank you very much to Alexander Gilles of First Metro Securities. Hope you found that interesting. Catch you next time. Bye for now.